On July 15, 2023, based in New York City, a major investment firm, Quantum Capital, initiated a pivotal expansion of its trading operations by integrating an advanced algorithm aimed at optimizing stock performance. The firm had built a reputation for its reliance on cutting-edge technology, touting its ability to leverage historical data effectively. However, this particular algorithm relied extensively on data sets that had not been sufficiently scrutinized for inherent biases. In its eagerness to enhance trade speed and efficiency, the company overlooked critical aspects of data integrity and algorithmic fairness. The first technical failure became evident when the algorithm's decision-making mechanism was activated in live trading sessions. Due to a misconfiguration, the algorithm utilized a framework that favored trading conditions prevalent during a specific historical period, inadvertently ignoring significant shifts in market dynamics. The system was dependent on outdated data inputs that did not reflect current market realities. Furthermore, a gap in the review process allowed this configuration to escape notice during preliminary tests. As the algorithm was deployed, it began executing trades based on historical patterns, which were ill-suited for contemporary market conditions. Within days of activation, measurable impacts emerged. On July 17, 2023, Quantum Capital's automated systems began executing trades at a rate of 5,000 per second, leading to a flurry of buy-sell orders that unintentionally cascaded into multiple trading platforms. Each uncoordinated order sent ripples through the market, resulting in a rapid decline in stock prices across various sectors. By the end of that trading day, Quantum Capital had accumulated losses exceeding $150 million. In less than 48 hours, other firms reported a 20% increase in trading volume, attributed in part to the artificial market movements triggered by Quantum Capital's algorithm. Internally, confusion reigned within Quantum Capital as the magnitude of the trading losses became apparent. Employees flooded the incident response channel with reports and alerts. Internal emails contained urgent requests for clarity and possible approaches to halt the automated trading. Some staff speculated that it could be a software bug, attributing the alarming patterns to system errors rather than fundamental design flaws in the algorithm itself. An early attempt at a partial fix involved adjusting algorithm parameters, but this short-term remedy proved inadequate as the underlying issue persisted. External signals initially trickled in slowly. User reports emerged on online trading forums, with traders noting unusual fluctuations in stock prices and questioning the integrity of the market. Monitoring tools generated alerts, indicating elevated volatility levels across numerous asset classes. Minor media mentions began to surface, framing the events as a consequence of unpredictable market behavior rather than a focused failure of Quantum Capital's technology. As the situation escalated, the firm sought additional support from external experts to review system operations. These initial investigations were hampered by a lack of precise logging that could trace the operational decisions of the algorithm. Without adequate documentation of the algorithm's decision-making process, piecing together the sequence of events that led to the precipitating sell-off proved challenging. Internal teams began assembling to address the oversight, but the focus remained primarily on mitigation, as the full scope of the problem became harder to ascertain. On July 19th, as attempts to stabilize operations continued, more severe market responses were recorded. Massive sell orders led to unprecedented volatility indices, with the VIX index climbing to its highest level in over a year. reflecting fear and uncertainty among investors. At this juncture, the broader financial community began to take note. News outlets reported on the volatility, but lacked a clear understanding of its origins, leading to rampant speculation and further market anxiety. By July 21st, alarmed by the continued disturbances in market stability, regulatory bodies took steps to investigate Quantum Capital's activities. They began to scrutinize the firm's trading patterns and the reliance on the newly implemented algorithm, questioning whether adequate risk assessments had been carried out before deployment. Amid this growing pressure, internal discussions shifted towards accountability. Executives wondered how the firm's practices could have prioritized speed and efficiency over critical ethical considerations inherent to algorithm design. While the investigation was still in its nascent stages, a growing realization set in. Quantum Capital had not merely suffered a technical failure, but had become embroiled in a complex web of decision-making practices that overlooked systemic risks. A cultural imperative to maximize profitability overshadowed the essential safeguards necessary for responsible trading. The forthcoming weeks would bring greater scrutiny not only to Quantum Capital, but also to an industry increasingly reliant on algorithmic trading. Unbeknownst to the organization, these revelations foreshadowed a much larger reckoning. A confluence of technological failure and ethical neglect was beginning to shake the foundations of trust between traders and the automated systems they had come to depend on. As investigations progressed, the implications of the algorithm's design and the biases it carried would reveal additional layers of negligence and complicity that extended far beyond Quantum Capital's walls. As the organization endeavored to rectify its course, the crisis was evolving into a significant moment of introspection for the entire financial sector, spotlighting the critical importance of ethical considerations in technology deployment. On July 23rd, as the situation escalated, Quantum Capital was compelled to release a public statement acknowledging the unprecedented volatility, but initially downplayed its association with the algorithm. Internal discussions revealed skepticism about whether the newly deployed algorithm truly caused the market disruptions. This miscommunication fostered further confusion among stakeholders and users, who received mixed messages about operational stability from the firm. However, as the concatenation of decisions mounted, traders worldwide were increasingly affected by the ramifications of the algorithmic trading errors. User reports flooded social media channels, with disgruntled investors launching campaigns demanding accountability and transparency. Stock price fluctuations were cited as direct instances of financial loss, compelling individual traders to absorb significant blows to their portfolios. Initial estimations indicated losses across various sectors, totaling upwards of $20 billion, creating a widespread ripple effect that included hedge funds and retail investors alike, many of whom were now questioning whether their trading strategies were inherently flawed due to the elevated volatility. By July 25th, Quantum Capital's board convened an emergency meeting to address mounting regulatory scrutiny and user dissatisfaction. During this meeting, the urgency of initiating a comprehensive audit of trading practices became increasingly apparent. Law enforcement authorities gathered evidence, launching preliminary inquiries into possible securities fraud while gathering data from affected parties. Subpoenas were prepared for the firm's algorithm developers to shed light on the missteps leading up to the turmoil, including the potential neglection of warnings about algorithm biases that had emerged during internal testing phases. In the following days, as outrage mounted, additional media coverage intensified scrutiny on quantum capital. An exposé published by a leading financial news outlet unveiled internal communications revealing that some engineers had flagged issues with the algorithm months prior to its deployment, yet their concerns went unaddressed. Quotes from chat logs indicated that discussions had devolved into debates over operational pressures versus systemic risks, further implicating a culture that silenced dissenting voices in the name of profitability. On August 1st, the fallout continued to compound. As part of a coordinated emergency response, Quantum Capital instituted immediate changes to its algorithm, temporarily disabling automated trading operations to avert further market disruption. However, the move was deemed insufficient by many, including various regulatory authorities who insisted on a comprehensive risk assessment and mitigation strategy. They began preparing formal legal notices that required the firm to cease all trading activities until a clear understanding of the algorithm's failures could be established. By mid-August, the situation evolved with the introduction of more rigorous auditing methodologies led by external consultants. These audits revealed systemic strengths and weaknesses not only within Quantum Capital's operations, but also across the broader trading ecosystem reliant on similar automated trading systems. Financial regulators initiated inquiries into how algorithmic trading velocity was being managed across various firms, fundamentally challenging existing practices within the industry. As investigations deepened, by late August, Quantum Capital faced intensified regulatory actions, with some executives reportedly resigning or distancing themselves from the algorithm's development and deployment decisions. The firm's stakeholders began discussions concerning potential bankruptcy filings as ongoing legal repercussions, combined with operational setbacks, hampered their recovery efforts. By early September, reports of law enforcement involvement became public as various regulators, including the Securities and Exchange Commission, SEC, amplified their investigations. In October, regulatory bodies moved to issue formal cease and desist orders against Quantum Capital while launching a broader review of algorithmic trading regulations. The impact of their findings rippled throughout the industry, prompting increased scrutiny on all trading firms as they were required to undergo their assessments to avert similar pitfalls. This scrutiny included imposed fines and more stringent compliance mechanisms on various trading firms sharing the operational characteristics tied to the flawed algorithm. As the months unfolded, the financial landscape continued to feel the repercussions of Quantum Capital's failure. By December, ongoing investigations led to high-profile arrests of several key company executives, as they were charged with various counts of negligence and securities fraud. These legal actions were not only punitive, but served as a stark warning to the technology-driven finance sector, emphasizing the need for ethical responsibility in algorithm design and deployment. By January 2024, as the investigations concluded, Quantum Capital faced permanent damage to its reputation and operational capabilities. The stock market had stabilized, but the trust once granted to automated trading systems remained markedly diminished. Institutional investors and retail traders alike cautiously approached automated solutions following their painful experiences. Driven by revelations about the biases enshrined within trading algorithms, industry-wide reforms shifted the narrative towards transparency, requiring clear documentation of decision-making processes within algorithms before their continued utilization. Ultimately, Quantum Capital's operations ceased entirely in March 2024 due to insurmountable legal and financial burdens, resulting in a complete shutdown of its trading services. the company became a historic case study within financial regulation literature, underscoring the critical importance of ethical oversight and systemic risk consideration in algorithmic trading practices. Final update. As of March 2024, Quantum Capital was permanently shut down due to regulatory sanctions and financial insolvency, marking a significant moment in the evolution of financial technology oversight.